Beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Hello and good afternoon. I welcome you to today's webinar, Admiral Markets Weekly Market Outlook. My name is Jens Klatt and I'm the moderator here for the upcoming 50 minutes around. We will have a look at what to expect in the upcoming week of trading. So far, when looking at the events this week, it seems as if nothing big really happened, and then big things happened. In fact, EURUSD broke below 112, is currently consolidating a little, but you can clearly see that there's no real demand here for the euro, which is a sign of that we are most likely to see further drops on the downside. So there's today's US GDP data set, which will be published at 1:30 BST, so in around 1.5 hours from now. Next week, the economic agenda is packed. So in Germany, it's or in Europe in general, it's a special week because on Wednesday we have a bank holiday, we have the Labor Day. And so a German index, for example, the DAX is closed, not possible to trade it. And the same day, the Fed gives her a statement for the month of May then. And decides on rates and all this. So while there shouldn't be so much action to be expected, still markets seem to be overly skeptical around the US dollar after this U-turn which happened here from December onwards, and which is most likely also a potential driver higher for US equities especially. And yeah, that could definitely cause some volatility, and this is exactly what we want to look at, what potential trading setups could arise from this. Before we start, nevertheless, I already can see here, thanks to Vincenzo, that everything's fine, so audio and video quality is okay. But before we start, we have to have a look surely here at the risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, a trade, please make sure that you read the terms and conditions of the service from Admiral Markets. So that we're only the first two sentences of the risk disclaimer. The full disclaimer can be found on the website admiralmarkets.com. As usual, we want to dig a little deeper into the impact the so-called ESMA decision had on the leverage and what this means, especially when trading with Admiral Markets. There's now differentiation between retail and professional clients, and this is especially true when it comes to the leverage which retail clients can use in the future. So the leverage restriction here is a max of 1:30 in Forex majors like EURUSD, for example, GBPUSD, and 1:20 for so-called minor currency pairs. This is true for Euro Australian dollar, for example, or GBP New Zealand dollar. But it's also 1:20 on CFDs, on indices like the German DAX here, DAX 30, or also gold. And when you're classified as a professional client, which is only possible if you meet certain criteria, therefore please reach out to Admiral Markets directly to find out about these criteria, which have to be met, and they are also, by the way, to be found then on the website. But please feel free to contact them directly. The customer support will definitely help you out. There's no such thing as a leverage restriction, but there's a big difference between retail clients and professional clients in general. Classic difference, which is that there is a negative balance protection for retail clients, and this is an unlimited protection, while for professional clients you have, in case of Admiral Markets and when trading with Admiral Markets, you have such a negative balance protection up to £50,000 sterling according to their policy, which is definitely something which needs to be mentioned here, and which is also one good reason why Admiral Markets is definitely worth a deeper look. This is me, the face to the voice you're currently listening to. There's sure also other reasons to choose Admiral Markets as a broker. For example, I'm located in Berlin in Germany. This is a city, by the way, where Admiral also has an office, so it's a global presence, in fact. But this is the next slide. So here in Germany, we usually refer to Admiral Markets as the so-called DAX expert, with a highly competitive offering here of a typical spread of 0.8 points during the main trading hours. What's probably of even higher interest, especially for short-term traders, scalpers, DAX scalpers in this case, is the Admiral Prime offering. Also to be found on the website, admiralmarkets.com. There you can trade with a typical spread of 0.2 in the DAX during the main trading hours, while then there is a commission added on top of that. So you have also 0.8 a point spread if you want, but nevertheless, due to the narrower spread, it is definitely worth to give this a deeper look, especially if you're a short-term trader, or respectively a scalper. Also, Admiral Prime and also Admiral Markets in general needs to be mentioned because of their very, very competitive FX offering. So feel free to reach out. Here, that was something I already mentioned, one world global offers. So one presence, for example, in Germany, in Berlin, but there's also offices in the UK. There's also an office, for example, in Chile. There's an office in Australia, where Admiral holds the Australian Financial Services license. What this could mean for your trading, also in terms of regulation and all this. Also, please feel free to reach out to Admiral directly, to the customer support, to the website. All informations are available there. There are the contact details. Also the YouTube channel, so the recording of this event. If you over the weekend say, hey, I'd like to give this some deeper thoughts, but I'd like to see again what Jens said here, feel free to check out the website, not the website, YouTube in this case, and listen to the recording, which will be published there within the next hours then after we ended this event here. Yeah, so that's it. That's it around Admiral Markets. Now let's have a look at the markets themselves, our agenda for today. So the questions we want to answer are: what are the key economic events in the coming trading week? What's the current bias in the FX, equity, and commodity markets? And then, which trading opportunities may arise? And then we switch over. Click here to the EURUSD, and you can already see what's happening here. What's happening here. So these are my lines. Nevertheless, this is already giving you a quite good idea of what I expect, in fact. So I'm right now very, very, very bearish for the euro, and I don't really see why one should be optimistic, why someone should expect here to see a bounce back above 112. Purely spoken from a technical perspective, in the morning I was reading an article. It wasn't in fact about the markets itself, but it was on regulation and regulative developments in the FX and then CFD industry. And there the author referred to the current low volatility at FX markets. So Deutsche Bank has volatility FX index measuring the volatility. And I'm in this industry for quite a while. So is it 10 years? So in fact, yeah, it's even more than that. But FX and CFD industry, it's 10 years. Before that, I worked as a trader, respectively trading assistant for a big stockbroker here in Germany. So I'm in the industry for quite a while now. But nevertheless, there was one period which really which stood out here. In fact, that was around 2014, and the volatility was on a record low in FX markets. And in fact, many brokers suffered because of this low volatility market environment. Only the strongest survived. By the way, Admiral yesterday published a report on their revenues here in 2018, and you can see there that they are obviously a very, very solid business, a very solid company here, with showing some really strong results for 2018. I think, in my opinion, it's noteworthy, by the way. But let's come back to the low volatility. So with low volatility, or volatility being so low, chances are definitely reduced here to see a sharp pullback back above 112. So from a pure technical perspective, it seems very, very unlikely. And this is only from a technical perspective. We could also go deeper here and say, well, you obviously see that the projected target after the break on this downside of the range can be found around 0.9 or 109, 109.50. This is based on a projection you can make here from 112 up to 115. So there were short attempts to break out above 115. That was especially here at the beginning of the year. But then the market drifted back again into the range and now broke out on the downside. So, and that's because of 115 playing a quite significant role here. The reason why I see the high of this range at 115. And yeah, if you duplicate this 300 pips range, you come out at 109, 109.50 around on the downside as a first target. Yeah, I have to say, I see, in fact, further losses and below that level. Nevertheless, it's the first potential target. Yeah, so now the fundamental reasons also are worth mentioning. So first of all, we want to have a look here at the US dollar probably. So the US dollar, and therefore I've prepared already a chart. You've probably seen it sometimes when I work with the weekly, or when I work out the weekly market outlook. Here you can see the commitment of traders report from time to time, and I refer there to the US dollar index future. And the US dollar index future is very important also when it comes to EURUSD, since the euro has a weight of 58% in this index. And then there is JPY, Japanese yen, and a pound sterling with another 13%, something like that. So these three currencies combined make 80% of the basket here. And so what you can clearly spot is that we are about to break significantly out of a trading range here on the upside, and further gains are very likely here as well. And now we come to the fundamental picture, which is not very positive, in fact, for the US dollar. Some of you probably remember several events in the past, weekly market outlooks we had here in webinars. You can also look up the articles from the months before, from starting of the year, if you want, in the traders blog section here on the website from Admiral Markets. So where you can find this is here, admiralmarkets.com, and there you have analytics and their traders blog. Just go back some months and read them up again. You can see that I never really painted a very bright picture for the US dollar. And this was and is still, by the way, it hasn't really changed, but nevertheless, probably I was a little too bearish on the U.S. Economy, at least for now. I think there's plenty of reasons to be skeptical around the U.S. dollar. Just have a look at the inversion of the yields curve here, 2-year, 10-year. U.S. Treasury notes, or an inversion points to a recession forming on the horizon. So we should be really, really careful when it comes to the overly economic outlook for the U.S. Nevertheless, the latest data was compared especially to, for example, the Eurozone was very solid. And today's data around the GDP, probably it comes out lower than the month before with 2%. Where it's expected. Still, it's significantly stronger than the data from the Eurozone, which is now then to be expected next week, by the way. So we have, can we see it here? Oh, it's in fact, it's not pointed out. Let me just look this up here. Probably it's here. Let me just have a look. Do we have it here? Here, there we go. There, it's on Tuesday, so it's on the 30th of April. There you can see the growth rate for the Eurozone, which will be published. And so why do I mention this? Is very simple. Even if we come in at only 2%, it's still very strong, solid reading. Plus, on top of that, there's, by the way, a quite good chance, in my opinion, that today's data will surprise on the upside, thanks to a very, very strong durable goods data set yesterday. And this is noteworthy because there was a poll which was run by Reuters, And here you can see that or not but all economists, in fact, all economists which were asked here from Reuters, see a Fed rate cut till end 2020. So minimum one, in fact. And now, when looking at the Fed Watch tool, I haven't prepared this. But just believe me, when you look at this Fed Watch tool from the CME, you can see that market participants are currently pricing in the chances of a rate hike of around 60% by the end of 2019. What does this mean? Well, it means nothing more than what the Reuters poll suggests is nearly already priced into the market. So any data set now coming out, especially after the developments of the last months, which are still, the fears are still there, and chances are still high, in my opinion, that there will be a recession in the US. But nevertheless, at least short term, the bias in the market is extremely bearish for the US dollar. And every data set which comes in now has a good chance to see a potential bullish run or acceleration of the bullishness in the US dollar we currently see. And this is especially true when looking at this significant breakout here on the upside, and why the US dollar could see further gains, in fact. And on the other hand, then if data from the Eurozone, for example, keeps on disappointing, well, chances are very, very good that this is then the potential driver for further losses. And this is only from a data set perspective. What we can also do is we can also look at it here when it comes to tariffs and the threats from U.S. President Trump. So during the earnings season, Harley-Davidson, for example, disappointed with their data set that was on, I think it was Tuesday, if I'm not mistaken. And what he said, where they stated that one of the reasons are definitely the tariffs the EU put on products from the US, and especially Harley-Davidson and motorcycles from Harley, and this affected here the earnings from Harley-Davidson. So and Donald Trump, even though not being good friends with the management from Harley, so they are very skeptical and critics from Donald Trump, US President Trump. Nevertheless, still Trump jumped by and said, well, guys, I reinforce my threats here on tariffs, and we will make sure that this unfair tactics, he called it. I mean, he started first with tariff threats, so discussing it as unfair. Let's put this in quotation marks probably. But still, the thing is that there's a good chance that the Eurozone will be affected negatively by tariffs in which way ever they may come then from Trump. Plus, on top of that, if a deal is finally struck between the US and China, I was very, to some extent positive, because I argued that I said, well, if they find a deal, it's very likely that the EU and the US will also find a deal. And this could then initiate, especially based on the current short buys in the market when it comes to the euro, it could also and surely initiate a short squeeze in the euro. What I didn't take into account, but which becomes especially true now after the breakout lower, is the following. If the trade deal is struck, the thing is that Chinese could move away from European competitors and move to US companies. And from a fundamental perspective, that means nothing more that the demand for euros from Chinese will naturally drop, while the demand for US dollar will rise. Because if you import goods from the Eurozone, surely you need euros, right? So that said, this is also a potential trigger for further weakness in the EURUSD, and so the overall outlook is very, very negative. And today we could easily see with the data set around GDP a first potential accelerator on the downside, which could then push us below 111 if data comes in better than expected. And also on top of that, even if the data set comes in lower than expected, still I think this could bear a chance for some traders who probably didn't take the break lower below 111.80 here on Wednesday, but want to wait for a pullback. I'm a little skeptical. That's something I definitely want to emphasize here. I'm very skeptical if there's a chance of such a pullback, because I've seen plenty of occasions where the US dollar, the EURUSD dropped and nearly dropped lower, and never saw any significant retracement. Still, a data set today, which comes in below expectation, could push EURUSD back to 111.80, probably 112. Probably 111.80, if at all. And this could then act as a potential short trigger, since this is only one data set and it won't change the overall fundamental picture I just painted. So which means a short spike higher is something to take into account here. Still, such a spike may be short-lived, and then we take it from there and drift lower then. So this is also something to take into account for today's data set around the GDP, and why it's definitely worth a deeper look. Nevertheless, I'm a little skeptical. Therefore, let's, for example, take this as an example here. Last year, that was April, May. That was when the situation in Italy worsened, back when the Cinque Stelle Movimenti in Italy became the elected party from the Italian people. Plus, on top of that, there was this coalition formed, and with the Lega Nord. So when we dropped, and then here really things got worse, you can clearly spot that there was no real retracement after we broke below 122. And that was also something we spotted in 2014, for example, after the ECB announced, at least between the lines, that there will be a QE program. What I'm talking about is don't expect big retracements to happen. First of all, low volatility, and second, the low yield currency euro usually has a high trend stability, which means if we break lower, as we did here, and take on momentum, we shouldn't really expect big retracements to happen, but instead just drift probably lower. And so this is definitely something to take into account when waiting for such a pullback. It could be that this pullback will never happen, in fact. Yeah, so that's a picture on EURUSD. In my opinion, currently, even though volatility is low, probably one of the most interesting currencies or currency pairs. Now, let's also have a look then here at pound sterling against the US dollar. Here, the picture is in fact the same. In the past, we had a quite positive correlation between the pound sterling and against the euro. By the way, you can also, let me just probably take this out here, the mini terminal, and bring up the correlation matrix. So this is from the Supreme edition, which you can download as an add-on from the website from Admiral Markets. And well, here you see EURUSD and pound sterling. They usually have a quite positive, high positive correlation. So plus 75. The higher the number, the deeper red the number, the higher the correlation. Now the thing is that if you see here on H4, there's a high correlation. Now the thing is, if you look at the daily chart and then at the last 300 bars, well, this is okay. This is cool. So 300 days, you can clearly see this positive, this positive divergence or correlation. I'm sorry, not divergence, correlation between those two, which means usually if one drops, the other should drop as well. So if I'm painting a negative picture for the euro, I'm painting such a negative picture also for pound sterling. But relatively spoken, I think that the euro is even weaker than pound sterling, which means if I'm taking two short positions, one in euro USD and one in pound USD, I'd outweigh the short position in the euro and probably give it a weight of something like 2/3 to 1/3 or something. But I definitely favor short engagements in both. And yeah, pound sterling broke below 129.50 here. And now here, first target is activated around 127.70. Probably if a broke below happens, then further losses are likely down to 24.70, 20.25. Here, also very interesting to note, let's switch back to the economic calendar for next week. And let's here use this filter again with those three red dots. So if you scroll down, what you can clearly spot here is next week on Thursday, on the 2nd, we have the Bank of England interest rate decision. While usually you shouldn't expect big developments here, the thing is that it becomes, I think, very, very, very interesting how the Bank of England talks in regards to the slowing economic outlook, not only globally but also in the UK, especially now with the prolonged Brexit uncertainties. And the thing is that any hint that the central bank here, the Bank of England, could keep interest rates on hold deep into 2020. And this is interesting because we had speculations that rate hike is likely around August 2019. So we were already quite hawkish, in fact, over a quite long time span now. And if there's any hint or any skepticism arising that the Bank of England won't hike rates before 2020 and probably somewhere in the second half of 2020, this could definitely trigger some pound sterling weakness. And then especially if the US dollar can keep on with its bullish momentum, and then development here could then result in the losses I just mentioned, and the probably push down to 24.70, 25, which is still a long way to go, still 400 pips. But volatility-wise, pound sterling is more dynamic in its moves here compared to the euro. That's also something worth mentioning. And yeah, so the overall outlook for pound sterling is also not very positive. So that's it on pound sterling, EURUSD. Probably before we look at the DAX, let's also have a look here at the dollar JPY. So I was in fact a little surprised to see after the USD broke out and really showed strength over the last days. I was surprised to see only a short spike higher in a dollar JPY on the upside that was here. That was a move which was initiated on Wednesday, and then we saw no follow through, but the dollar JPY stabilized here and then dipped lower. That was initiated most likely yesterday. It was also, by the way, we could somehow see it already in the morning yesterday. So Thursday morning, JPY was it was not extremely strong, but it was definitely you could feel it, you could see it, that the JPY was doing quite well, especially against the US dollar. And that was triggered then on the downside when the Dow Jones came in weaker into the day, recovered most of the losses, but that was mainly due to the weak earnings from 3M here, which disappointed, came in below expectations. And short term, there was some kind of skepticism arising and some kind of fear that now the time has come and the market will finally reverse here. When looking at equities especially, that we will fail probably dramatically, let's say, against those all-time highs here and won't make it above them. The thing is that so far it was only a small dip, by the way, but also there's lots of things reminding us to the developments in 2017. Very similar. So there we had low volatility in equities, market drifted higher, and then there was a short bounce. And when the Dow Jones lost only 100 points, everyone was going crazy and was like, oh my God, now it's time to sell, and we are about to break lower. And instead of breaking lower, the market drifted higher and higher and higher and higher and higher and higher. And the big bang came, yes, and we were all sure that it will happen. No one knew really when, but nevertheless, it took months until in February 2018, then there was this sharp rise in volatility. And the same seems to be true here, which is, by the way, one of the reasons why I'm a little skeptical if there's such a great chance, especially also when looking then at the DAX in a few minutes, that there's coming a push lower, but instead I expect the DAX to drift higher, even though risk rewards become more unattractive in my opinion, but that's a little later on. So that was probably then here one of the reasons yesterday why we dipped below 111.70, and now there's something really interesting happening in Japan next week. It's called the Golden Week, and they have they take 1 week off if you want. Unfortunately, I only know how to spell this in German. In fact, let me just have a look here. So they get a new, and now it's not a king, but it's in Germany. The word for this is Kaiser. Let me just see whether I can find it here. One sec. So it's, what do we have? Emperor? Really? Can we call this Imperial? Okay, yeah. So they get a new Imperial if you want. And so equity markets, Japanese equities, and also bonds are not traded next week. Still, the JPY, so FX and the currency markets are open. Interesting enough, in January, there was a very interesting development taking place. Some of you probably remember that day. That was right at the beginning of the year, the 2nd of January, when there was this flash crash in a dollar JPY, which pushed us as low as 104.70 here. And we ended the day, in fact, significantly higher, but still it was a drop of something like 400 pips within seconds, minutes probably. And that was also a day when there was a bank holiday and very thin liquidity in the rollover period in FX markets. And now the same is true for today, or respectively for the next days to come. We will see very low volatility or liquidity especially during this rollover period. And yesterday I've read an article in the Financial Times which made a potential flash crash, another flash crash, again a topic. I'm not sure if this is really realistic, but what we can say is that there's probably some traders who are probably trying to prepare themselves for such a flash crash and working with orders then somewhere in the region around 109 probably, and probably even lower than that, just to make sure that they get filled if such a drop really happens and if they're then prepared for such a drop. The thing is, the more market participants bet on such a drop to happen, the unlikelier it becomes that such a drop will happen. Still, I think with the thinning out liquidity, and especially if the developments around the US dollar, as I described it at the beginning, play out, I think chances are very good that dollar JPY sees another attempt to break higher and succeeds then and will continue with its move on the upside up to 114.50, 115 probably, a level which you can, by the way, spot when looking at the daily chart. So not at the H4, but here. So there is this region I'm referring to. So the highs here of 2018 and also 2017 here. So this region, this is then the first target on the upside, which we could look for. Still, what we definitely need is the data to come in better than expected and to really, to show the willingness of further buyers than stepping in. But as long as volatility stays low, the JPY is definitely a currency you should favor to sell instead of buying it due to the risk of attachment it naturally has. So in low volatility market environments, you use the JPY usually as a funding currency for carry trades. And as long as there is no volatility or increase in volatility and no real risk of hitting the markets, then you naturally do not see a significant strength in the JPY, and especially with the thinning out market environment next week due to this golden week in Japan. You should not expect volatility to significantly rise in the JPY. So the advantage in dollar JPY also is to be found on the upside. Yeah, so that's an dollar JPY, and now let's have a look then at the DAX 30 here, and this still very, very strong run we get to see here. We continue to move higher after we made it back above this purple line. This is the SMA 200, the SMA 200, so the target on the upside stays active around the September-October highs, 12,450 points. I already pointed out a few minutes ago why I favor further gains on the upside. This is due to the fact that obviously there is a strong willingness, especially from the Trump administration, to help U.S. equity markets to make new all-time highs here. And especially after now only the data around 3M and Intel disappointed, or earnings here, but Amazon, for example, came out quite strong, and all other data which I heard about and which can be considered to be significant, well, they all they all came out as or better than expected, which is usually a sign that you should expect further gains to come, or at least the market drifting higher. On top of that, there's also Another thing which is probably worth mentioning. Oh, I'm sorry. I closed the window I wanted to show you. 1 second. Let me just see whether I can find it. It's a statistic. So usually, market participants tend to try to fade such a break, or not feeling really comfortable, let's say, if the market breaks to new all-time highs. But there's also a very interesting statistic here. It's a tweet from Ryan Detrick, and by the way, if you're on Twitter, I highly recommend following this guy, because he brings some really interesting statistics, and it's definitely worth watching these. So if you look here at this, can we just increase this somehow? Oh, there we go. So what does this picture show us is the following. Usually, as I already said, market participants usually fear new record highs, and the average analyzed forward price returns for the S&P starting from record highs here is usually positive. So it's usually a good bet to buy a break to new all-time highs, even though I have to say I somehow I understand the fear, let's say, based on the not very attractive risk-reward ratio. So I usually prefer to wait for a pullback to happen, and try to buy this pullback then, because I think the market is already quite extended on the upside. And even though I don't know how strong it will perform on the upside, chances are high that there will be rather soon or later a quite aggressive push on the downside. And even though from a pure statistical standpoint, it only keeps you to sit tight here and just hold on the position, it's from a risk reward perspective definitely something to be worried about a little. Nevertheless, from a pure absolute number, when looking at returns, it's definitely a good bet to be long with such a break happening. And again, with the U.S. administration here being willing to manipulate, I really want to use this phrase, because I think it's definitely fair to say so, especially after we brought up the plunge protection here around Christmas in person of Stephen Mnuchin, for example, and from there the market just pushed higher, and there was a complete U-turn in the monetary policy, which is to be expected from the Fed, for example. I think there is a significant higher chance that we will minimum see a push to 3,000 points in the S&P, if not even higher than that. And the same is true also for the Dow Jones, which I see right now a minimum up to 30,000 points. Not necessarily today or tomorrow, but in the days, months to come, in fact. And as long as we do not see any risk-off drivers and any escalation in terms of trade war or something like that, I think we will definitely, or we should be really careful in shorting the current dynamic and expect a big drop to happen. And even if we rather soon or later see a pullback, such a pullback is good for usually long engagements, which is in case of the DAX true. Well, if we get to see such a pullback down to 12,000 points again, former highs, the mode stays bullish as long as we trade above 11,800, 830 points. And even if we drop below this level, but stabilize above this purple line, the SMA 200, the mode stays neutral. So I'd become skeptical if we get to see a drop back below 12,000, and then also a drop back below 11,700, below the SMA 200 here. So yeah, that's it on the DAX. And then let's have a look at, oh, by the way, another potential driver, by the way, higher, which should definitely mention here is surely the weak euro, right? So a weaker euro is positive for the German export, which is usually also a potential driver for the DAX in this case. Also something which is worth mentioning. And so finally, let's have a look at gold. And here, interesting thing developing right now. And in this regard, I should use this as a chance to make an article topic, which we published here in the Traders Block section yesterday, or was it on Wednesday already? I don't know. It's around head shoulder formations, and currently it seems as if the pullback against the neckline is taking place. And the thoughts here, you can see it here. The Traders Block, you go to Analytics, Traders Block, and there you have to how to trade chart patterns, gold head shoulder formation. And if you click on this, you can see an example of what I'm obviously talking about here. And then you can see there's a sequence of higher highs and higher lows. So now the head shoulder is reversing this trend. And after the break of the neckline here happened, you can see that now we are about to see a potential pullback against this neckline level 1,290 USD around. This is a definitely interesting level to watch, and if there are any signs of a pullback forming, I think the risk reward could be really interesting for short engagements. I've painted a quite bullish picture for gold. I'm sorry, not for gold, for the US dollar, and we know about the usual negative correlation between the US dollar and gold. So if one is rising, in this case, in our case, the US dollar, the other should drop, which is in this case gold, and vice versa. And that said, this current move higher here towards 1,290 USD is probably a very interesting chance for short engagements. And as long as we do not reconquer 1,310, so this is our potential stop level, further losses down to 1,235 USD, 230, probably even lower, a little lower than that, 220. Is definitely an option, and then something which could be of high interest and for gold traders especially. Yeah, and that's it in fact from my end. I just hope that you enjoyed this webinar and that you can use it for your trading in the upcoming week of trading. If you have any questions, please feel free to reach out to Admiral Markets directly. They will forward the questions to me, or yeah, you can reach out to me on Twitter if you have any comments. You can ask the questions below the YouTube video. Use any chance. We're definitely there to help you. And that's it from my end. So happy trading. Watch your stops. Have a nice weekend. Enjoy yourself, and talk to you again then next week on Friday, which is, by the way, the first Friday of the month, which is NFP Day. So we definitely have a very, very interesting data set to come then that day. Also, somehow based on what I just presented, and also we know what the Fed delivered then on Wednesday. So definitely very, very interesting day then. I definitely look forward to it. So all the best from mind. Happy trading. Watch your stops. Talk to you again next week. I look forward to it. See you, and bye-bye.